Greetings from our team at Robare and Jones Wealth Management. This is Jack Jones, the managing partner, with our August monthly market update. Before I begin, I want to thank our clients for the trust and confidence that you place in us. The very best part of our day is time spent directly serving you. You'll notice one change next time you're physically in our office. Our conference rooms now have the names of famous Astros players. So if you see a bobblehead in one of our conference rooms, you'll know why. We have Altuve, Biggio, Bagwell, and Nolan, which is our new conference room. You'll also notice we sent out some communication recently about our core value project, where as a team we gathered to define things that described the way we serve our clients, team members in the community, and came up with do good, be thankful, and give back. And as a physical representation of that in our office, we have candles that were purchased in support of a local nonprofit. So please, next time you're in, you'll see the candles on display. Please take one or more of them. As it relates to markets, we sit as of mid-August around 6,500 on the S&P 500, which is at or near all-time highs. Although it's not been a smooth year, year to date from peak to trough, we were down as much as 19%. And a lot of that happened in the second quarter, which was a wild quarter. Tariffs were not to be ignored, and there was a lot of kind of hair on fire response. We'll see that in early April, when tariff news was announced, the markets promptly, over the course of just a few days, went down 10%. And then when a 90-day pause was implemented, up 9.5% in a single day. So a lot of volatility early in the quarter. And then by the end of the quarter, you had Israel and Iran in conflict, and we joined that conflict on June 21st. So if you were to think about those things that kind of were relevant in Q2, you wouldn't think that by the end of Q2, markets would be trading at all-time highs, but that's precisely what happened. And again, kind of it's knowing what we don't know, and the things that don't seem possible are, again, the quarter that started with tariffs and ended with Middle East conflict, started Q2 at 5,600 and ended at 6,200, which again doesn't seem possible. But one of the things we don't know is we never know what the market's priced in and what other things the markets are responding to. Now, there could always be the thing that shakes things up that is still on radar. There's still things that could go wrong in the back half of the year. And we'll talk about some of those in a second. So one other kind of removal of something that was uncertain was the tax bill that passed on July 4th. The biggest takeaway is we went from uncertainty regarding taxes in 2026 to certainty. So that was an element of risk that was removed from the market a few weeks ago. As it relates to growth in the economy, the most recent read for Q2 of 2025 was 3%, up from a slightly negative Q1. So that would indicate, at least for now, recession isn't on the radar. As it relates to inflation, most recent CPI was just under 3 at 2.7%. So that was a pretty okay number and basically in line with what the markets were expecting. However, producer price index, which is a measure of wholesale inflation, came in a lot hotter than expected. It was up 0.9% in the most recent month. So that's something to keep an eye on as well. As it relates to jobs, the most recent jobs number, only 73,000 added when there was expected 100,000. And more significantly, as you'll see with this white graph, is that we were revised jobs down in the two prior months, 258,000. So not only was this July a big miss, but May and June were significantly revised down. So kind of a weak jobs number most recently. And as it relates to market components, we continue to have a top-heavy part of the U.S. capital markets, where you've got the top 10 companies in the S&P 500 contribute almost 40% to market cap. one of the questions is this too hot? And when will that kind of bubble burst, so to speak? One of the things that you see is that the top 10 earnings are close to matching the top 10 in market cap. So this would say that there's not a big delta between contribution to earnings and contributions to market cap, which would argue for the perhaps justification of the percentage of market cap being so high. And if we expand this out, Mag 7 is still driving the market in a lot of ways, but there's been some disparity or dispersion among those names. So you'll see Meta, Nvidia, and Microsoft still doing exceedingly well year to date. Amazon and Google, less so, still up, but not up as much as the other three. And then you have Apple and Tesla down pretty significantly through the end of July. Another area of dispersion is the US versus the rest of the world. This is a look at what the S&P has done over the last 15 years compared to the ACWI World Index minus the US. So you're seeing basically a doubling of performance of the US versus the rest of the world. And within this time frame, this is just a stunning chart that shows that back to roughly 40 years ago, the US was only 30% of global market cap. That is now up to 2/3 of global market cap. So we've just been in a period of dominance in the US as it relates to share of global market cap and performance of the US versus the rest of the world. And in fact, to kind of further talk about this, this is global market cap and all publicly traded companies as of mid-year 2025 was at 133 trillion. The top 10 US names are 23 trillion of that. So 20% of global market cap roughly is in 10 US companies, which is just a stunning statistic. That said, as it relates to US versus international, you have seen international do well this year. A lot of that is due to currency impact. The dollar's down about 9.5% year to date. Whether that is 9.5 on the way to an even weaker dollar or whether that is the max dollar drawdown remains to be seen, but that's something that we're paying attention to. As it relates to the Fed, this is much in the news. What the Fed did over a period of time of raising, then cuts at the end of 2024, and then pause. And the Fed remained on pause at the most recent meeting, although you had two dissenters to the rate pause who wanted a cut. The first time that's happened since 1993. And the expectations are now that we get a cut in September. So how are consumers feeling? Sentiment is at a 5-month high. So that's worth kind of paying attention to. And as it relates to kind of summarizing headwinds and tailwinds for the balance of the year, so tailwinds, things that are supportive of markets or pro-growth policies, deregulation, and market support. We seem to have an administration that's sensitive to what's going on in financial markets, both bond and equity. Some headwinds and trade tensions and tariffs still remain somewhat uncertain. Deficits remain a concern. We're still spending over $1 trillion just to service debt, which is the first time that's ever happened. And policy uncertainty as it relates to spending, hiring, et cetera. There's still some uncertainty as it relates to all of that. We will be rebalancing in the coming weeks, and we'll be sending out trade notes in advance of that to talk about how the things that we talk about today are impacting the economy and financial markets and making adjustments. So more to come about that soon. None of this is a replacement to contact us directly to see how all of these things apply to you. So feel free to give us a call, leave no question unanswered. We're here to serve you. And so with that, we'll close. Again, we want to thank you for the trust and confidence that you place in us. We hope you have a great rest of your summer, and we look forward to seeing you very soon, hopefully at our next forum in October that we'll be sending out news about in the coming weeks. So until we see you again, be well and take care.